FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's May 31st, 2018. More peril, more threats. Italy, will it go down? EU, dollar. What is going on in the world? Well, right now, focus of every major money manager, money person's attention is the precarious state of Deutsche Bank. Just 6-8 months ago, the German Democratic Republic, otherwise used to be known as West Germany, bailed them out. And guess what? 6 months later, it's time for another bailout. Well, before we get into that, as always, I love when you send emails. It's the best part of my day when I wake up in the morning and see an email from you. And Bill, shout out to you. Use your question, and I hope we gave you a good answer. Anyway, the email address, once again, kl@kerrylutz.com. So what about Deutsche Bank? What about gold, silver? What about the world financial system? Well, Craig Hemke's with us now, a.k.a. Turd Ferguson, tfmetals.report.com. Craig, welcome back.
Kerry, it's always a pleasure. Hope you're well.
Hey, man, it's like, how can you not be well when you're doing what you love? And, you know, when you're not happy, you just do some more of it and you get happy. It's really that simple. So, hey, it's always good to have you on the show. Deutsche Bank, you've been following them for freaking ever, okay? It seems like we've talked about them so many times, and yet the more things change, the more they stay the same, right? Yeah. 6 months later, they need another bailout. I thought everything was fixed in December. What did I miss here, Craig?
How do you fix $50 trillion in derivatives, right? That's the problem. And it ripples through the entire global banking system, not just the EU. But we can start there because that's where the problem is coming from now. And it stems almost really, you can trace it even back to the dollar being so strong over the last 6 weeks. That's put great stress on the emerging markets and their currencies. And then by extension, that has rippled all the way into Italy, which is also being impacted by, can you say government turmoil when they really haven't had a government now for a couple of decades?
And they seem to have done fairly okay. If they didn't have the euro, they'd probably be doing all right. But because they're euro, exactly. They're a euro, and then they're the fifth largest economy in Europe. I think they're the third after France and Germany. They're the third largest economy in the EU, the fifth largest or seventh largest in the world. I mean, this is potentially frightening, isn't it?
Yeah, and the problem is in Europe in particular is that the banks are linked together really in kind of a mutually assured destruction pact.
Daisy chained. They're daisy chained.
Yeah, that's exactly right. And where one bank owns another bank's debt and 10 other banks' debts, and of those 10, they all owe the other 10, and they're all linked together. So if one bank has trouble, if they're all of a sudden having trouble with their debt or financial picture, it affects all of them. And then in the global order of things, that affects the U.S. banks too. And the best example of that is Deutsche Bank, the biggest bank in Germany. Obviously, one of the biggest banks, if not the biggest bank in the entire EU. You go back to 2007, Kerry, back in the pre-financial crisis days, Deutsche Bank was trading around $160 a share.
Oh, my God.
As we speak here this morning, it just made a new all-time low at $10.50. Yeah, what does that tell you? Is Deutsche Bank, again, as a key counterparty, not only in debt, but in all these trillions and trillions of dollars of derivatives, and the argument is always like, well, it's okay. That's a notional amount. And it doesn't really sort out really. Okay. Until on one side of those derivatives, they don't have the money. Mm-hmm. And that's what I think ultimately the concern is Deutsche Bank, the AIG or the Lehman the next financial crisis. And I mean that as AIG kind of was left holding the bag in 2008. AIG was the one that kind of shouldered all the losses. Everybody piled on all of their losses, and then got the massive government bailout and all that other kind of stuff to try to make everybody whole. Deutsche Bank kind of feels like that. The fact that it's breaking down and now moving towards single digits tells you a lot. And it sets us up for, it's like you said, you go back 6 months ago, this wasn't even on anybody's radar. 2018 was going to be.
It was on your radar and mine and people like us who follow this stuff, but everyone else thought the problem had been solved. And I think a good analogy to the international global banking system is think about how the electrical grid works. Okay. And think about that blackout that we had in the US a few years ago. It's like if one station or one part of the grid goes out, it becomes a contagion and all of the grid goes down except Texas, which has its own grid. And that's what the global banking system is like. If one little section of the grid that's significant goes down, the entire grid is going to go down.
Yeah, it's a good analogy. And, you go back to, Kerry, as recently as mid-January. So what are we talking, 4 months ago? Deutsche Bank was trading right below 20, and now it's just barely above 10. So, what's that telling you? What should that be telling you? And as you look at it and you try to look ahead, again, this was not you weren't seeing people on CNBC and Bloomberg talking about Deutsche Bank back in January. So what are they going to be talking about, by September? If this continues to unravel? Look, the central banks of the world have created a complete Frankenstein monster of these markets now. You can't even see, the U.S. can't even get the 10-year note above 3%. And they can't. And now the Fed even admitted, whatever it is, 2 weeks ago in that kind of in-between meeting at the 1st of May, the minutes came out 2 weeks ago. They admitted as such. They're just complete. Can I say bullshitting?
Yeah, this is a family show, but as long as I keep it clean, guests can say whatever you want.
They're BSing. They're shoveling garbage, shoveling manure, trying to say, oh, we're not really going to worry about inflation. And that inverted yield curve, that doesn't mean anything in 2018. We're not worrying about. Look, man, I've been saying now for months, the Fed has painted themselves into a corner. If they continue to hike the Fed funds rate, then one of two things is going to happen, and neither of them are good. Either the bond market's going to completely sell off and break down, and long rates are going to go to, the 10-year note's going to go to 5%, which means mortgage rates are going to skyrocket, credit card rates are going to skyrocket, student loan rates are going to skyrocket. The entire economy is going to collapse under the weight of that, servicing all of that existing debt, all of that. And you're going to get this massive recession, and God knows how that's going to ripple through. If the Fed keeps hiking the Fed funds rate and the bond market rallies on the long end, which, again, we went from 312 to 280 just in the last couple of days on the 10-year note, they're going to invert the yield curve. And any student of economic history knows that there's really not any exceptions to the fact that if you invert the yield curve, a recession follows. So either way, if the Fed keeps hiking the Fed funds rate, they're going to spark a recession. Well, wait a second. Nobody's talking about that. Everybody's talking about rate normalization and balance sheet reduction, all this other garbage. Well, the Fed 2 weeks ago came out and told you, well, maybe not so much. Maybe we won't be raising the Fed funds rate. They use this cover of inflation and everything not being so great, or letting inflation get a little hot. But again, who's talking about that? The notion is still, oh, yeah, the Fed's going to hike 2 or 3 more times this year and 3 or 4 more times next year. Really? The Fed funds rate's going to go to 3.5%. You think that's going to work? Really? Look what's already happening. Just getting it up here to 2.25 or to 2%, whatever the hell it is now. So it's going to be a very interesting summer and the rest of this year. Wildly unpredictable, not only on economic sense, but a political sense and geopolitical sense. And so this notion that the financial media tries to put out about, oh, everything's fine, just keep, buying your stocks.
Right.
This time, that may not be the best idea.
Hey, so how are we going to make America great again?
Well, that's a good question. Kerry, that's another thing. Look, let me put it this way. I wrote in first week of January, I said there are 3 themes for this year. And they all have to do with the dollar, frankly. There's political risk, there's geopolitical risk, and there's de-dollarization risk. And the political risk that I guess maybe looks a little less likely here in May than it may have even as recently as a couple months ago. But the political risk is, what if in typical midterm elections 2 years after the president loses Congress?
Yeah.
I mean, that's what's happened before, regardless of whether, what the polls say or how much people like him.
Many times.
It could happen. And then what if by December, we're talking about the Democrats that now control the House and the Senate moving to impeach Trump? Is that on anybody's radar?
Yeah.
I mean, nobody's talking. But it's certainly conceivable. And so, that's all hanging out there too. And I think it all ultimately pretends to gold moving higher, not lower. Are these people out there trying to say that somehow gold's going to $1,100? That's not going to happen.
Hey, so Maxine Waters is the great hope of making America great again, huh? I mean, have you ever?
Exactly. And that's something. And that's the thing. How the Democrats going to win on a platform that is nothing but hate Trump, Russia.
Yeah.
I mean, you would think they've got to do something a little more proactive.
Yeah, like
history suggests, though, that that first midterm election usually isn't good for the new president. So we'll see.
Yeah, my thought is this is a little different than usual. I mean, all the money printing and the inflationary stuff that he's done has actually appeared to boost the economy. Long run, it's a prescription for disaster, let's face it, because you just can't make something out of nothing unless the policies and the country decides to create wealth again. This is just distraction. But for right now, it's looking like, hey, man, maybe this guy knows something. It looks like it's really almost working, right? But you and I know that it's a chimera and it's illusory. It's really economics that cannot persist over time because it's destructive. It's wealth destructive.
I would say, Kerry, too, that at least the last 3 or 4 years of Obama and everything else that was going with it was not real conducive to economic growth. And plus all of the other, the Fed stuff, lowering interest rates to zero and all that stuff, none of that works.
No.
But there was kind of coiled spring is not the proper analogy, but there was a little bit of that, and that just the relief and maybe things will finally be different, and the hope kind of tended to kind of feed into things for maybe the bulk of last year.
Yeah, I would agree.
Then that can really only take you so far.
Mm-hmm. Well, the tax thing definitely is a short-term stimulus and has definitely helped.
Yeah.
And probably didn't really cost that much because with all the repatriation that took place, even though repatriation, and I know, is really not what it is because the money's already here. It's just in a different company's name.
Right,
so they put it in the main company's name and they pay 15% taxes on it, 15.5%, and everybody's happy. But
again, that's a one-time deal.
Yeah, it's a one-shot.
And that's kind of like the bounce. And the other thing, Kerry, when did I miss the memo where all of a sudden it's okay if you consider yourself to be a Republican and a conservative, it's okay to run $1 trillion budget deficits? Did I miss that?
Yeah, you missed it.
I remember in 2009 getting a Gadsden flag and hanging it off the side of my house because that wasn't cool. And now it's $1 trillion deficits as far as the eye can see, and no one gives a damn.
Yeah, no one cares. Isn't that remarkable that nobody cares about it except maybe you and me and a few others? This isn't good, and it's not good for long-term viability, and it's just not going to work. It's going to be counterproductive in the long run because that you reach the point where each additional dollar of debt doesn't stimulate the economy. It actually winds up penalizing the economy. We were there a few years ago. We're going to be back to that point very shortly. Yeah. This is not a question about it. This is just the way
the Fed,
works.
The Fed can do their thing, but and they've obviously tried to manage things and try to keep the stock market afloat to keep that illusion that everything is just hunky-dory. But all the gains have gone to the upper income groups, right? Mm-hmm. We've seen that. We've seen the household net worth numbers over the last 10 years. It's only the top 10% of households in earners that have seen their net worth grow. It just can't be sustained forever. Eventually, Mother Nature catches up with you, and it's just going to take one kind of event, or maybe even a collection of things, like an eventual U.S. recession that you just can't hold off forever. That's going to all of a sudden impact things. These $1 trillion deficits assume 3% GDP growth for the next 10 years. Well, that's not going to happen, and so it's actually going to be worse than that. And the whole Ponzi begins to just kind of go parabolic. All the stuff that you and I have talked about now for 5 or 6 years.
Yeah, correct.
So
years we've been talking about this, and the chickens is coming home to roost. So
eventually, no doubt about it.
Parabolic Ponzi, which will be the headline of this show. So then we go back to gold. Gold was getting ready to break out above its 200-day moving average, and then a funny thing happened on the way to Nirvana, right? As always.
Well, we've seen this now. Look, people can look at it however they want. My view has been, since it occurred in December 2015, that bear market, if you want to call it, ended then, because prices were below the cost of production. And we've rallied since. The Fed has hiked the Fed funds rate 6 times, and gold has rallied anywhere from 10 to 30% on 5 of the 6 occasions following those rate hikes. Mm-hmm. So we're clearly headed higher. The chart has suggested since late last year that we would get back up to about 1,400 by late this summer. Mm-hmm. Well, we sure look on pace to do that over the next 60 or 90 days. So I feel good about that. And at the end of the day, this to me, Kerry, and I've said this on multiple occasions. I don't think I've discussed it with you yet. I've been doing this, I've been in the public domain, if you will, now since 2010. And this year, 2018, reminds me of 2010 in that as we began 2010, QE1, which was supposed to be the only time we were going to take this unusual step of quantitative easing. We're never going to monetize the debt. That's what Ben Bernanke said, right?
Never.
QE1 was over. There was this, look at the green shoots. Here comes the economy. Everything's going to be normal again. There was never going to be more QE. Silver was trading $16 to $18. Gold was trading around $1,200. That's what we looked like in 2010. Well, here we are in 2018. The economy, look at the economy soaring. The Fed's going to normalize the balance sheet. Interest rates are going to go up. Everything's normal. Everything's fine. Everything's great. And silver's around $16 to $18 and gold's $1,300. By late 2010, became clear that, guess what? There's going to be a QE2 for $600 billion. Mm-hmm. Okay, and eventually there was QE3 and all the other things that they tried to do. Well, anyway, the announcement of QE2 in November of 2010 was kind of the catalyst that then silver went from 18 to 48 in 6 months. Gold went from 1,200 to 1,900 in 10 months.
Short period.
And so where 2018 is a lot like 2010, by 2019, all those risks we laid out earlier about political risk, geopolitical risk, de-dollarization risk, the economy rolling over, the banks, who knows where it comes from. By 2019, the discussion is going to be like it was in 2011. Wait, there's more QE coming. The economy is rolling over. Look at the debt. It's the same conversation that we had in 2011, and that's going to be sending the metals higher again. Like I said, I don't know how many times I've discussed that, whether I've already discussed that with you, but I've been kind of saying that now all year, and this point, I'm sticking to it.
I think you're spot on here. I thought the system was going to collapse in 10, 11. So the fact that it didn't, the fact that it didn't, they bought it some more time. I don't know that it's necessarily going to collapse now, but there is going to be some major eruptions, just like the volcano in Hawaii is spewing lava out and cutting off access roads and limiting people's means of escape. that's the volcano that's coming in the financial system, because nothing, we've been talking a long time here, Craig. Nothing has changed in that time where we've spoken, except that the debt's gotten larger and the spending more irresponsible. And like you say, parabolic Ponzi. And the other side of the parabellum there is a crash. Hey, what about cryptocurrencies? We don't talk much about them, you and I, but it was just interesting how the whole crash of Bitcoin was orchestrated right around the first of the year.
Right around the time that Bitcoin futures started trading. How about that?
That's all a coincidence. Come on, you're a conspiracy theorist, tinfoil hat, right?
It's on too tight. Yeah, it's on too tight. To me, it's again, one man's opinion out here in the middle of nowhere, banging on his computer. But to me, it was pretty clear what happened. Prior to December 18th of last year, there was only one way to buy Bitcoin, and that was to actually go in there and buy Bitcoin.
On the cash
and to find someone to sell it to you, price had to rise a lot of times, right? Because there was a finite amount. And I think that last run from Thanksgiving to almost Christmas was probably the banks preparing a war chest ahead of the futures that started trading December 18th, and they were acquiring Bitcoin. Now, all of a sudden, you have these whales in there trying to buy it, and that's why price went from 5,000 to 18,000. And once the futures started trading, it became very easy to make money because you can, it doesn't take a lot of Bitcoin
you have a platform
for sale to crush price.
Because you got a platform. You have the platform. Once you got a trading platform in any market and no one else has it, then you can do what you want with that market and nobody can stop you.
That's right. And if you can go in and short some Bitcoin futures and then dump a couple thousand Bitcoin at some inopportune time, price crashes $2,000-$3,000, and then you can buy your Bitcoin futures back, and your prop desk at Goldman or wherever just made a boatload of money.
Yeah.
And so I think once the banks got involved, once again, they ruined it for everybody. And here's a fun thing to look at. Go back and look at uranium prices back in 2007. They started, it's almost the exact same chart as Bitcoin. It was going straight up toward the end. And then as soon as uranium futures were instituted.
A funny thing happened.
But I love Bitcoin and I love the crypto. I guess maybe I'm unusual in that sense. I think I think they're complementary. It's basically the same thing as gold and silver. Allows you to save outside of the fiat system, allows you to save money in something that is not just constantly being devalued by the central banks. I think it's teaching a whole new generation of people, the millennials, that money is not just simply a paper dollar bill, Federal Reserve note. And I think all of that is wonderful and terrific. And eventually it's speeding up the process of de-dollarization because we're already seeing the first drips and drabs of using Bitcoin and blockchain as an alternative to SWIFT and the U.S. dollar reserve system, and I think that's the direction it's headed. So I'm all for it. I think it's great. I hope it, at some point stabilizes, and I have no doubt it'll turn and go higher again. And you just got to be careful with the others. I like Litecoin.
Ethereum.
I don't go down there and pick off the ones that are trading at 5 cents and stuff and try to, it's not my deal. But Bitcoin's great.
Yeah, definitely. I'm a big fan of it, of Bitcoin. Like Trace Mayer said, the infrastructure that's in place for Bitcoin is just far superior to anyone else's, and that's what you really have to look at, because the rest of them are all extremely thinly traded markets, which means easily manipulated. So. In
the banks, assuming that they're not just nefariously trying to destroy it, if the banks are just simply in it for a profit, hey, they can just as easily profit on the upside in that same process where they can buy the futures and then go buy the Bitcoin and make profit on the upside too. So it's not like, again, assuming they're not just nefariously trying to crush it for the governments and the central banks by, killing the confidence in it and forcing everybody back out of it. They can clearly manipulate it and make money to the upside too if they want.
Yep, for sure. Just like with gold and silver.
Exactly. No doubt.
Yep, for sure. So, well, that's it for about now. So people want to go to your site, tfmetalsreport.com. Tell them what awaits them there.
It is. I like to think, and I've been told, I did an interview this morning where the guy said this. I mean, it's really unique, the site. It's not like your regular internet site where people comment and flame each other and trolls and all that kind of stuff. It's populated by people that, I mean, we all kind of see the world the same way. And the information provided by the site members, you know, the links, the discussion, the comments, I just think is unique. Anyway, and it's not like there was some master grand scheme. I said, okay, this is really going to make me a lot of money if I can pull this off. No, it just kind of happened organically. It's a wonderful place. I do some analysis as well. To be a full site member and read what I write every day and hear what I do in my podcast, it's a whopping $12 a month or 40 cents a day. So it's not a bank breaker to join. But I think people enjoy the camaraderie of the place more than anything else. So tfmetalsreport.com. All
right. And hey, we'll have a link to it in the show notes to this interview. As always, Craig, and questions, comments for Craig, myself, email us kl@kerrylutz.com, Twitter feed @kerrylutz, and Facebook page, Financial Survival Network. Craig, we'll talk to you again real soon. Thanks for coming by.
All the best, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.